Two investors, same asset class financial instrument. One celebrates a 20% gain, the other regrets a $500 loss. How? Because returns aren't just numbers, they're context. This is the playbook for understanding percentage versus dollar returns, and why your time horizon changes everything. What are percentage returns? Percentage returns are the universal language of performance. They measure the relative growth of an investment, independent of the initial amount. Whether you invested $100 or $1 million, a 10% return is a 10% return. This makes it an indispensable tool for comparing the performance of a diverse portfolio. You can weigh the growth of a tech stock against a real estate fund or a government bond, all on a level playing field. It provides a standardized benchmark to evaluate how efficiently your capital is working for you, stripping away the noise of initial investment size. As the financial advisors at SmartAsset aptly put it, percentage returns show efficiency, not impact. They tell you how well an asset performed relative to its own starting value, but they don't tell the whole story about what that performance means for your financial reality. What are dollar returns? Dollar returns, on the other hand, measure the absolute gain or loss on your investment. This is the tangible, real-world impact on your wealth. It's the actual cash you can withdraw, reinvest, or use to fund your life. While a 50% gain sounds spectacular, on a $100 investment, it translates to just $50. Conversely, a modest 5% return on a $1 million portfolio yields a substantial $50,000. Dollar returns ground your strategy in reality, connecting your investment decisions to concrete financial outcomes. A crucial tip to remember is that dollar returns matter most when you are planning for specific financial goals, such as making a down payment, funding your retirement withdrawals, or budgeting for a major expense. It's the number that answers the fundamental question: how much richer or poorer am I? Time horizon, the missing variable. The missing variable that bridges the gap between these two metrics is your time horizon. Time is the silent partner in every investment, the force that can either amplify volatility or unleash the power of compounding. In the short term, markets are unpredictable. Volatility reigns, and price swings can feel dramatic. A sudden dip can create significant dollar losses, while a sharp spike can deliver quick gains. The short-term lens magnifies the day-to-day noise, often leading to emotional decisions. But as you extend your time horizon, the picture transforms. The power of compounding begins to take effect. Small, consistent percentage gains start to build on themselves, generating earnings on your previous earnings. Over decades, this exponential growth can turn modest savings into significant wealth. Finance strategists explains that longer horizons tend to smooth out short-term volatility and dramatically increase the potential for higher returns, allowing the fundamental growth of your assets to overshadow the market's daily whims. Short-term versus long-term thinking. This fundamental difference in perspective naturally separates two types of market participants: traders and investors. A trader, whose horizon might be measured in days, hours, or even minutes, is primarily focused on the immediate dollar impact. Their goal is to capitalize on short-term price movements to generate quick, absolute profits. For them, a $1,000 gain today is more valuable than the potential for a 10% annualized return over the next decade. They live and die by the dollar return because their strategy is defined by immediate liquidity and cash flow. In sharp contrast, a long-term investor focuses on percentage growth over time. They understand that the path to building substantial wealth is paved with consistent, compounded returns. They are less concerned with daily fluctuations and more interested in the underlying quality and long-term growth potential of their assets. Their strategy is built on patience and discipline, allowing the power of compounding to work its magic over years and decades. As Investopedia wisely states, your time horizon defines your strategy. It dictates whether you prioritize immediate dollar impact or long-term percentage growth. Dollar-weighted versus time-weighted returns. To further refine our understanding, we must distinguish between dollar-weighted and time-weighted returns. The dollar-weighted return measures your personal performance, taking into account the timing and size of your cash flows when you add money to or withdraw money from your portfolio. It reflects your actual, individualized outcome. If you happen to invest more money just before a market surge, your dollar-weighted return will be higher. If you withdraw funds just before a rally, it will be lower. This metric is heavily influenced by your own market timing decisions. The time-weighted return, however, is designed to isolate the performance of the investment itself, removing the effects of your cash flow timing. It calculates the return over specific periods and chains them together, providing a pure measure of how a fund manager or a strategy perform. A practical tip is to use time-weighted returns when evaluating the skill of a professional investment manager, as it gives you a fair comparison of their performance. Use dollar-weighted returns for your personal financial planning, as it tells you the true story of how your own investment behavior has impacted your portfolio's growth. Global case studies. These principles are not just theoretical. They play out in diverse economic landscapes across the globe. In the United States, retirement planning is heavily reliant on time-weighted metrics. Financial advisors use these figures to project long-term growth and help clients build diversified portfolios designed to harness the power of compounding over decades. The focus is on achieving consistent percentage returns to meet future dollar-based needs. In Nigeria, the high volatility of the naira means that naira-based returns can be misleading. An investor might see a high percentage gain in local currency, but when converted to a more stable currency like the US dollar, that gain could diminish or even turn into a loss. Here, understanding both percentage and dollar returns in a global context is critical for preserving wealth. In Europe and China, national savings and investment programs are structured around long-term, time-weighted performance. Whether it's Germany's stable savings culture or China's massive state-guided investment funds, the strategy is geared toward harnessing long-term growth, with individual investors encouraged to think in decades, not days. Meanwhile, in India, the concept of systematic investment plan SIPs has become a cultural phenomenon. Millions of investors commit to investing a fixed amount regularly, leveraging the principles of dollar cost averaging and compounding. Their focus is on the long-term percentage growth that transforms small, consistent investments into substantial wealth over time. Conversely, in the real estate markets of the way, particularly in cities like Dubai, the conversation is often dominated by dollar returns. Investors are drawn by the tangible, high-value gains from property sales and rental income, where the absolute dollar profit is the primary measure of success. The insight is clear: the metrics you prioritize must match the realities of the market you are in. Conclusion: returns are more than numbers. They're stories, they're strategies, they're signals. Understanding the difference between percentage and dollar returns is not just an academic exercise. It is the foundation of intelligent investing. It allows you to decode the story your portfolio is telling you, to craft a strategy that aligns with your goals, and to read the signals the market is sending with clarity. Align your metrics with your time horizon. Know whether you are playing a short game or a long one, and invest with the confidence that comes from true understanding. Grow relentlessly.